It's, never been a market bounce ever like we've just experienced. And who's got an explanation for it apart from, mumble, 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 mutter, Donald Trump, mutter, mumble. Yeah. The point is, the economic reality that we have been in is over now. And the reality is that there's a runaway train and we're on it. And, there's the bond market, which is the senior market in the US and in Japan, is going rattle, rattle, shake, 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 rattle, rattle, rattle. And when the bond market does that, everything else gets affected more. So what happens next? Who knows?
On this episode of What the Finance podcast, I have the pleasure of welcoming back Clem Chambers. So Clem is author, journalist, and founder and CEO of a New FN, Europe's leading stocks and markets website. So Clem, thanks so much for coming on the podcast today.
Thank you. My pleasure.
No problem. Looking forward to the conversation. I think we talked to probably close to 2 years ago, so lots definitely changed since then. I think at the time you were quite bullish, and that was correct. And now, I guess I'd be interested to hear what your current thoughts on the economy and markets in general at the moment.
Well, I think if you're an investor and you're not confused, you don't really know what's going on, because this is complete chaos land. And I think long term, that's pretty negative. Short term, it could go anywhere, and it is going anywhere. 1 minute there's going to be 150% tariffs with China. The next minute it's going to be 10%. And the next minute half the people are saying it's 30%. And then the next minute, the courts say you can't do it. And the next minute, and it's like up, down, and it's making for a very, very unpredictable time. So it turned out today, for example, that I've cracked one of the difficult problems of why the UK is strong at the moment. And it's because the Japanese are bailing out of their bonds and hedging the dollar and the yen by buying into the UK stock market. Okay, well, that's, quite complicated and difficult to find out. But, one has to have really lots of open questions right now. And if you can solve them first, there's a lot of money to be made there. So that's kind of really where I am. I'm actually positioned in precious metals because that's obviously a good place to hide. Piles of cash, because cash is great in the short term. When the going gets tough, in the short term, it's always good to have a fistful of dollars. And I'm also positioned in deeply contrarian British stocks because that's my specialty. So I'm sticking to what I know best. And it's good. It's very, very good, actually, but nowhere near as good as if I just sat tight through this whole crazy thing. But there's no way. I mean, my portfolio would have been down like everybody else's 25% if I hadn't got out before the roof came in. And I haven't got back in again. Well, not to a great extent, because I can't put my hand on my heart and say I know what's going to happen next. It's, never been a market bounce ever like we've just experienced. And who's got an explanation for it apart from, mumble, 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 mutter, Donald Trump, mutter, mumble. Yeah. The point is, the economic reality that we have been in is over now. And the reality is that there's a runaway train and we're on it. And, there's the bond market, which is the senior market in the US and in Japan, is going rattle, rattle, shake, 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 rattle, rattle, rattle. And when the bond market does that, everything else gets affected more. So what happens next? Who knows? There's two waypoints in my book. There's the midterms in America. And in the midterms, if Trump keeps both houses, or I should say the Republicans, but, is that really what it is anymore? But if the Republicans keep both houses, we're in for 2 more years on top of the 18 months ahead of us. And that will really be, quite a ride. If they lose even one house, let alone both, if the Republicans lose the House, then basically that's it for Trump's ability to do much. So that really is the next major waypoint, apart from all the crazy stuff that's going to go from here to then. Are there going to be tariffs on China? How high are they going to be? What about Europe? How high are they going to be? Are they going to be any at all? It's like, and what's he going to say next? Oh, we're going to get rid of, I don't know, we're going to all eat whale meat now or something. every few days is something else wild coming out. And, that I feel has to have a negative strategic effect on the market because, uncertainty lowers the value of assets. So I think that's a key thing to think about. But you've got to trade what you see. And what we're seeing is that Europe and the UK is outperforming the US. So there is a exit of liquidity from the US, and it's hardly surprising, and it's hiding and hedging in Europe. So that is a theme, so that is likely, I think, to continue. So if you've got if you're sure that things are going to be good, you should be playing. Me, I'm unsure, so I'm only playing in things I've got high confidence in, which is military defense stocks in the UK, and precious metals, and deeply contrarian stuff that I think has got a chance of becoming less unpopular.
Okay, yeah, really interesting to hear your perspective on that. So what would give you more confidence? Is there anything that would give you more confidence in next year to say that, okay, I'm willing to jump?
Well, I think what would give me more confidence is if Donald Trump says he's going to go on a world cruise, and we won't be seeing from him for 6 months. Because at the end of the day, the old saying used to be, if America catches cold, everybody gets pneumonia. Well, I don't know what happens if America gets schizophrenia. So that's a fundamental. In the previous administration, they managed to chain him down like Gulliver on the beach in Lilliput and kept him from doing a great deal. Well, he seems to be relatively unchained at the moment. And as much, I mean, I was hoping he was going to be excellent. I was hoping that he was going to have had time to reflect and come back, in a good shape to do great things. But I know, however much I go towards his position, every time I hear him talk and he's a lot talk, I go, oh no, I've got to sell everything. Oh, got to move to Chile. Oh, I've got to build a nuclear bunker. Oh no. So it's really, it's not trading what I see, it's trading what I hear. And I think I don't get it. I talk to Republicans and I talk to Democrats, and the Republicans are in this kind of crazy, we don't understand what he's doing, but we know it's right. He's so clever, he's beyond us, and it's going to be great. And I think, oh no. Ooh. So, and obviously he can't put a foot right as far as the Democrats concerned. I mean, he could turn water into wine and they'd say that was terrible. So, there's this massive disruption in the US and the way that the US is, which is still just about the leader of it's the leader of the free world, but it's still just about the leader of the world. And that can't be good either. It can't be good to have a country so divided, so polarized, and all the economic outcomes of that. And so, it really is very, very, very difficult, because we are really literally in a new world, in a new era. And ultimately, it's not actually about Trump. It's about the conditions that are causing Trump and, insane Democrats as well. That this situation is being created, and effectively is created by the internet. It's created by social media. And that's not going to go away. So it might even just get worse, and it'll be some other people. They always. It depends on what school of politics and economics you come from. The old school would say, there's a great man, he changes history. And then there's another school, which is, don't tell anybody, but it's a bit Marxist, which says that the situation creates the leader. So Napoleon was created by the French Revolution, etc., etc., etc. So Donald Trump is created by the situation, not the other way around. So this sort of different mode of operation, this may go on and on and on and on and on, and that's also a bit sobering. So it's very, very, very different times, very, very interesting. A lot of money to be made if you can decode it. And what I've so far decoded is that we're in a twilight of the gods situation here with America, and Ragnarok in Washington. And if they don't play a very clever hand in the US, God forbid, Yeah, it's China's moment, because what people don't realize is, and people go, no, that can't be right. No, that can't be right. China has twice the money that America has. So money, good old fashioned money, it has twice as much. Now, okay, it's got 4 times the people, but it's got twice as much money. Yeah. America hasn't got all the money in the world. America is no longer the country with the most money, with the most wealth. It's China. So, well, who's in charge then, eh?
Yeah, so much to unpack there. I think if we go back to the start about Trump and how he's, yeah, as you said, I think everyone's sort of living off his words and what he's saying, and it's really driving
Or
the
hanging on
market.
them, hanging
Hanging
by
on
them,
them, yeah, hanging by them.
by the fingertips.
Yeah, and you've probably heard of the taco trade, which is Trump always
Yeah, I
chickens
mean,
out. What do you think of that?
I think it's very, very important to try at least to get away from the straw man thing. Attack the man, not the ideas. Attack the person. I think that that's a fallacy. The question is he right or wrong? And is what he's doing going to work or not? If you are a slick politician that everybody thinks is great and everybody loves and never says the wrong word, and you do the wrong thing, it's just as catastrophic as somebody that comes across like a television reality show host. Oh, hold on a minute. It doesn't matter. It's whether what you do works or doesn't work. It matters what you do. Is it good or bad? So attacking Trump always chickens out. I mean, well, I would like to think he will. I certainly don't want him to go, I'm really annoyed by this taco trade idea. I'm going to follow through with 50% tariffs on Europe, and I'm going to, blow up the world economy. No, we don't want that. We don't want that. So, I don't think anybody can do anything but flip a coin and say what's going to happen next. And if you can, get the odds a little bit above a 50-50 and be right about what's going on, there's a lot of money to be made, because it will affect asset prices massively, because he is the emperor of the free world, and if that emperor is Caligula rather than Augustus, that's a big impact.
Yeah, massive impact. So it sounds like for next year you're sort of going to be a little bit caught. You're going to be very cautious, and yeah.
Well, I might not be. You see, if suddenly the angels sing and say, good grief, do you realize that fast food is just going to go mental? I'll go all in on fast food. Not that I normally do that sort of thing. I don't normally like to be undiversified. But really, you can be. I mean, if you're a buy and holder, and I wrote this in an article, I said, if you're a buy and hold by the dip, you're going to be buying the dip here, and good luck with that. And it proved to be exactly the right thing to do. All those buy and holders who say, oh, what are you playing at? Just buy and hold, buy the dip. Don't worry about it. It's all going to be great. Everything is awesome. Those guys, completely right with a vengeance. So, I'm not going to say, oh, I'm always right and these people are wrong. That'll have their comeuppance. It's about the market doesn't listen to me. You've got to listen to the market. But, these are very, very, very disrupted times. So, you've got, if you're going to play the game of not buying and holding and buying the dip, you've got to be trying to, unpick and decode all this. And if you can decode it, oh boy, there's huge amounts of money to be made, because these are going to be big swings. There's never been a crash bounce in the market like we just had. Not as far as I can tell, ever in the history of ever. So, you've got to say that this is kind of quite a lot about how it's going to be. And if you can get the right model, then, it's going to go up and down 3 times, and then it's going to go down double on the 4th, and then blah, blah, blah. If you can actually be right about that, you can make very, very, very big money in the short term. So, it is a trader's paradise if you can get it right. So, if suddenly you go have an epiphany, this is going to do this, then it's a great time to stake a bit more than you would normally do. And in a way, I'm probably in that situation, because our piles of precious metals, I've got a lovely portfolio of diversified precious metals. If you can call a diversified portfolio of precious metals lovely, I don't particularly like precious metals normally. And then I've got the defense stocks because I think that's a no-brainer, and the market seems to agree with that. And then I've got some things which are kind of linked to defense that are very unpopular. The rest of it, I'm stacked waiting for that moment when the angels sing and says, you need to buy Kentucky Fried Chicken or whatever that is. Failing that, I'll just be slowly, moving back in again with my fingers crossed, hoping that I haven't been right all along.
Yeah, and I think we've seen that. You've probably seen the data where there's quite a lot of institutional money on the sideline at the moment, even though the market's at all-time high. So it seems like there's lots of people who sort of think similarly, but then there's the risk of, as you said, if they miss out and if the run keeps going higher, does everyone start chasing the tail and it's going to then massively go up?
Well, all the old professionals, all the famous guys who are famous for getting it right, they're all going, I don't want anything to do with this. And of course, they've all been wrong. I mean, I was lucky enough to get out before the roof came in, so I'm not really that much out of pocket. But as it's run on a bit, I've missed out on about 3% of my return, which is nothing in comparison with the 20% that I avoided on the way down, without any basis for imagining it was going to jump like it did. So effectively, I paid a 3% hedging fee on missing that particular tariff tantrum. And I'm happy. I would have had a thoroughly, I don't know what sort of time, miserable time. Because, if things go down when you knew they were going to go down and you didn't get out, that's not happy. And if they bounce and you don't know why, that's not happy either. If you're wrong and it makes you money, that's no good. So I'm quite happy to have kind of, missed the oncoming train and fallen in the nettles. I think I can cope with the nettles rather than getting hit by the train. So, but the point is, I think everybody has to realize that this is a highly random, highly volatile situation, and that they should act accordingly. I mean, people say, what should I do? And I say the first thing you should do is go through all your investments and find the ones that you don't know why you've got it, and then get rid of it. Because you've really got to know or have at least an anchoring on what you're doing or have done now. It's no good just, why not? Just forget it and just carry on with your life and it'll all sort out. Everything's awesome. And the Everything is Awesome Brigade have done just fine. So I can't argue with that. But I think really now's the time to be watching very, very carefully. And, the market will at some point give you a steer, because we haven't yet got a resulting trend. What we've seen in America, the roof came in, out came the magical fairies and kicked it back up again, but it hasn't actually recovered to where it was before the roof came in. There's still a gap there. And you could actually kind of look at Europe and say, oh, that little gap's gone from America, it's gone to Europe. Yeah. And you can see why, because, Japan is in a bit of a spot where it's realigning its economy to have higher interest rates, and all the things that go along with that. And then you've got people in the US going, oh, treasury bonds, oh dear, oh, we had a good auction, oh, excellent, oh no, we've had a bad one, oh no, oh, it's gone up, so there's definitely stress in the American treasury market. And now Mr. Trump, who was going to balance the budget, is actually going to have a budget which is going to be even worse. I mean, decode that one. So it looks like inflation in the US is going to make a bit of a comeback. I mean, it's kind of low now. If you're old school and you think inflation is 5%, a couple of 3%, not so bad. But it looks like it's going to go back to 5% or maybe higher with the tariffs, which will there be, will there, won't there? And then you've got this inflationary budget coming out. And then Doge, which was going to be a thing. Well, all the founders of Doge who are going to save $1 trillion have saved 150 billion and have left. The original guy left like 10 days after he started. I suppose he went through the door and said, hello there. Oh, no, bye. So the Doge thing, the cutting waste and theft and whatever they say they're going to cut, that's obviously a dead duck. Although if you're a Republican, no, it's going to be great. It's going to be wonderful. No, it's dead duck. So the cut in the budget's going to be a dead duck. Bigger deficits is going to be a thing. if there are any tariffs, that's going to be so inflation, probably higher interest rates. That looks like what's shaping up. But of course, there could be a complete change of policy again any minute now. And the policy that they're espousing now is one that I've been writing about for a long time. And it goes something like this. You've got a 3% deficit in your fiscal deficit, but you're growing the economy at 3%. So your income's coming in. So you've got, and all your debt is being eroded by 3% of inflation. Okay, so you've got 100 inflation, you've got 100 debt, it's going to be 97 at the end of the year, but you add 3 to it, and your economy grows. And then you have inflation, which knocks 3% off, and then you add 3% to it. That's sustainable, totally sustainable. But you've got to grow your economy. And if you can grow it at 5%, then your actual, in real terms, your debt to GDP is going to be shrinking. So shrink. So in the end, you've got a massive, a 200% bigger economy and the same kind of amount of debt, but in number terms, but actually as a percentage of your GDP, it's less. And that's how you try to get rid of it. But of course, the politicians come and say, "Oh, we got some slack here. We'll spend some more." So it never really, your debt never goes down. It doesn't have to go down. It's sustainable, right? So it goes on forever. But of course, then your politicians pop up and go, "Yeah, but we could have another 1%, couldn't we? Yeah, well, let's spend another. We'll get it back tomorrow, I promise." And then it gets more and more and more and more, and you go 80% sustainable debt to GDP, 90%. Oh, there's been an emergency, 100%. Oh, 105, 107. Oh, well, if it's 107, 110, well, making it. And that's what politicians do, and they do it until suddenly, bang, you're Argentina, and that's the fear of this. And this new Republicans who are conservatives are meant to be reeling this in, aren't they? But it doesn't look like that's going to happen. It looks like they're going to be letting it out. And then with all these conniptions and lack of statesman-like delivery and going around upsetting everybody and making it difficult for the people that are buying your confetti to actually buy it anymore because you're attacking them. It's kind of an incendiary situation, isn't it? And I think the fragility, the volatility is the key thing that everybody can understand is there. So that means that you make the money off the volatility if you can find a way of capturing the value of that volatility. And maybe it means that there's more risk and therefore there's more reward. But you better get on the right side of that because you don't want to be on the wrong side of that. And so it's all up in the air, and it will all condense and gel out. And it's a question of understanding it before it's happened rather than after it's happened. And I think that's why I'm positioned in precious metals, because that's a hedge against insanity. Defense, because obviously there's a lot of geopolitical fragility out there, and it's only going to get worse. Yeah, so precious metal goes up because of that, and so do defense stocks. You can see them all over the place. The defense stocks getting more and more stronger, particularly in Europe. And anything that might speak to those two things that is currently not popular, like steel, for example.
Yeah, and I agree with what you're saying, how it's just amazing how things have shifted. As you said, they were very much Doge, cut it, balance the budget, trying to raise revenues through tariffs. And now it's the opposite. It's just, tariffs aren't happening, but we're going to keep spending more, tax cuts. It's very, and I guess a lot of people said that's the case. That's what he did in his first term. So he's going to do it again in the second term. And it seems like that's the trajectory that we're going.
Well, I mean, you see, the thing is, you've got to trade what you see. And what you're seeing is a recovery in US equities. It's not got back there. A complete recovery in Europe. So you can't say, oh, it's all going to come unstuck. It's all going to come to an end. However, which is the direction of what's the trend now? Is it up or down? And that's really over the last N years. I was practically just out of school when the stock market trend went from that way to that way back in the early 80s. Yeah, and we've had this upward bullish trend for a lifetime, practically a lifetime. And some people would argue that's what equities always do. But actually, if you go back hundreds of years, it isn't necessarily what it always does. And there's been some pretty long bear markets from 1929 to 1957, there was a bear market in, well, not quite 57, but it took from 1929 to 1957 for the Dow to recover to where it was in 1929. So it does do well to remember there can be long periods of no returns in equities. However, are we still in that long-term systemic bull market, or are we going in, or have we gone into what amounts to a bear market that might last 1, 3, 5, 10 years? Now, I don't think we're in a 10-year bear market, but I think the direction of travel is that away. And I wouldn't write off another crash this year, for sure. So the point is how can you be in and catch the good news while avoiding the potential of taking a blow to the temple from something that random that comes out of Washington? And that is the game at the moment. That's the only call you've really got to make, is how do I avoid a catastrophic and sharp downward move and still capture a long-term upward move in the markets, or the fact that you can actually be in them. I mean, if you sat on a stock that's paying a 5% dividend and it ain't going anywhere this year because, you know, it's going to go up a bit and down a bit, well, you're going to get 5%, aren't you? But if you go, I can't be in that because, you know, it might go down 20% because somebody says something silly in Washington, you can't afford to look for a 5% upside with a 50% chance for a 20% downside. You know, do the maths, right? So, you know, that is the hard part. Normally, the answer is you should be all in. Yeah, it's fine. Just avoid anything disastrous that might happen, like COVID. You know, keep your eye out for the asteroid that might strike. And then you need to be all in. Well, that's not the call now, is it? The call is, should I be in at all? And if I should be in, how can I be in and avoid anything of that might turn up at random from you know where? Or not just there, actually. I mean, you know, there's so many loose cannons out there. Avoiding the loose cannons is really the name of the game. Or saying, oh, look at these loose cannons. I therefore should be investing in this because those loose cannons are going to do this. And you know, that's why I'm in defense and gold, because that's the only that's the obvious place to be when there's loose cannons rolling around the deck.
Yeah, definitely sounds like you're very positioned for that potential scenario. And then what else do you watch? Are there any other sectors that you sort of aren't in at the moment, but you're keeping an eye on, or any other companies that you're sort of watching?
Well, I mean, there's this thing, and I mean, it depends on your audience really, but if you're well, actually, here you go. So if you're American, I would be looking at ADRs, because there's all this, what's going to go on with the dollar, right? The dollar is too high. It's not going to collapse and burn and disappear, but it is too high. Just pull out the yen dollar chart for the last 20 years. Pull out the euro dollar chart for the last 20 years, and you'll see the dollar took a step up and is really high now. Yeah, and it would seem a reasonable call to suggest it might realign to back to where it was perhaps in the not too distant past. Certainly, what would be the reason for the dollar to be strong with the current conniptions going on? So at some point, there's going to be a realignment. And actually, Trump basically said he thinks the dollar should be weaker. Well, if the dollar is going to be weaker, there's going to be a lot of people that don't want to be in dollars, and they're going to go elsewhere, aren't they? So foreign ADRs, and I think Japanese ADRs are quite interesting, because, you know, they're great companies paying fat dividends and the yen is really weak. Well, what happens if the yen stops being really weak? You know, they're going to go up in dollars quite a long way. Now, if you are European and you are obviously denominated in euros or pounds, you've got to be thinking about, well, if people run for cover out of the dollar, they're going to continue to run to other currencies that are major. So the major currencies you could imagine as being, or freely tradable anyway, yen, pound, sterling, and euro. So anything that's denominated in euros or pounds, if there was a rush to the exit from the dollar, it's going to show up in Europe. So you could look at, say, I don't know, a chocolate company in America and a chocolate company in Britain, and say, oh, chocolate companies are a third of the price in terms of earnings as in America. So actually, that's not a bad place to be, yeah, because, you know, as the dollar rights itself, so that value will come into the UK stocks and push them up. So there's a potential that a run or a repricing of the dollar will actually reprice in a good way European and UK and Japanese stocks in terms of dollars and in terms of their local currencies. So that is the sort of place that I'm looking at. But really, I want to see what Trump's going to do with these tariffs. I mean, if he does go right, I'm fed up with people saying, Taco, I am going to stick 100% on China or 40% on Europe, and that's going to stick. You know, the implications of that would be very dramatic. If he is going to, set a deal at 11.5% or something that is just an ache rather than a head blow, then it's a different market altogether. And I can't say that anybody can tell me they know what he's going to do, because this whole strategy is that you don't know what he's going to do. And that's his negotiation tactic, is to be crazy like a fox, a very large fox. And he certainly convinced me. and therefore, I want to see, what he's going to do with these tariffs in the next few weeks. And I think until that's over, it's anybody's guess which way that's going to go. And if you're telling me that you're inside his mind, all I'm going to say is, I'm very sorry for you.
Yeah, that's a great point, though. I think if you look at the last few years, that's why there's been so many foreigners investing in the US, because you didn't just have assets going up, you had also the dollar, roaring up as well. So as you're saying, there's this now opposite trend where it could be withdrawal. So we see the Mag 7 and all those other companies that have performed very well. Maybe it's the opposite trend in the near term, and the European and Japanese peers are going to perform.
Here's a contrarian theory for you. It's a personal one. You won't see it out there. I'll put my tinfoil hat on. Okay. Everybody says, oh, well, China's got $1.3 trillion worth of American treasury bonds. Oh, what happens if they sell them? Well, actually, they have. They've got them down to 800 billion now, which is starting to be getting on for a trivial number when you think American debt is 32 trillion. So they've only got 800 million. They haven't got one unit of American national debt in China anymore. It's less than the 1 trillion. Nonetheless, 800 billion, quite a lot. Well, if I was them, they'd all be gone already. Yeah, but of course, you don't want to actually, say, I'm selling them down, I'm selling them down. You ring up your investment bank and say, you do a swap for me, will you? You write me some derivative contracts to make these go away, will you? And they go, yeah, sure. As it comes in, just tell us and we'll hedge that out. We'll swap that out. Well, so anyway, so all that 800 billion, that's gone. That they don't actually have them anymore. They've already sold them or swapped them, or they're no longer held in that manner. Well, if you wanted to have exposure to dollars, where would you put them? Well, you put them in equities, wouldn't you? And I wouldn't be surprised if them and a lot of other treasury bond holders haven't swapped out their treasury holdings into American equities. And all those crazy valuations of a very small pinnacle of highly liquid, that's the key, right? Highly liquid equities isn't actually a load of American treasury bonds being swapped out into American equities. So the treasury bond situation, interest rates, is highly linked to the price of those stocks. So it's like if you want to make the stock market go up, you just squeeze the bond market and up goes equities. So if you want to be the Fed and you want to support the equity market, you go out and you go on your tools to squeeze bonds, and that money pops out and pops straight into equities, and up they go. So there's this kind of link between American debt and the height of the American stock market. Well, that could be interesting, because if value suddenly rushed out of the bond market, or people started to want to actually really dump them in a different manner, that could have a pretty interesting effect on the Mag 7. And I think what you're seeing, one of the reasons for this big bounce, is people swapping out of treasuries and swapping into the Mag 7 and equities like that, i.e. using their collateral of treasury bonds as a way of going effectively a little bit short of treasuries and a little bit long of equities, or a lot short of treasuries and a lot long of equities. So you're seeing interest rates go up and the stock market go up with it. Why is that then? Well, I've kind of sold my treasury bonds, although they look like I'm here. I've lent them and received cash. And I've taken that cash and I've stuck it into dollar equities, haven't I? So, and therefore you don't get that thing where interest rates go up and equities go down. You get the opposite. So, and, if you were a big holder of treasury bonds, i.e. the Middle East or China or Japan, you might be thinking in those terms, mightn't you? And that might be one of the reasons why those equities have gone up. And then you go, well, I've got too many of these blooming equities now. Oh, start selling them and buying European ones. So really, the whole market, everybody says, oh, Elon Musk just made a Twitter. That's not really how the market works these days. It works by these huge money flows. Yeah, huge liquidity flows from one asset group to another. And there's definitely lots of funky stuff going on with treasury bonds and Forex and equities right now. And they're all linked up. And that's the big moves that are underway. And when someone comes out and says, my country doesn't like your country anymore, that can really change monetary flows.
Yeah, it's a great point. I know, Swiss central bank does it. They buy US equities for their currency. We know obviously Norwegian sovereign wealth fund do it. But as you say, there's obviously all these countries that are receiving dollars. If they don't want to buy bonds because they're depreciating, they're not the safe asset anymore. You either go into gold or equities, as you say.
Well, one of the big problems out there, which is a false problem, is this idea of mercantilism. And that comes from the good old days. The French kind of invented it, really. And they went, hey, have our stuff that we make, have our rubbish, we'll take your gold. We'll keep your gold, but you keep taking our rubbish, keep giving your gold. We'll stash the gold, you take what we manufacture. That's what China does. Okay, and the idea is that that's bad because the company's just taking the mickey, he's taking all the money and just shipping crap to the people that are buying it. But actually, that's based on something that doesn't apply today. And that bases on the reality that back in the day, it was gold and silver. So you took the money, gold and silver, and you put it in a vault and you gave them whatever apples or whatever you were making, shirts. Yeah. And there's only a finite supply of gold and silver. So the mercantilist country ends up with all the money in the world and everybody else ends up with T-shirts. And that's really not a good place to be. But in the modern world, you're not doing it with gold and silver, which isn't money anymore. You're doing it with confetti. So you're taking their confetti and giving them T-shirts. And everybody's shuffling their confetti around and swapping it out for the equivalent of T-shirts. So what you can do is just take all this money in and just put it in a reserve like the Swiss do. To stack it up, because it's money's money, right? And you diversify your money. So rather than a finite supply of gold in the basement, you stash an infinite supply of other people's currencies. And that would be fine. So they could drop this idea of mercantilism is bad and just crack on with, shipping around confetti and T-shirts and just like the Swiss have this vast sack of other people's money and other people's assets, Microsoft and stuff like that. That's not bad. They're not going away, are they? It's not like, all right, gold cannot go away. It cannot rust. But if you own huge reserves of global assets, that's just as good. But in economists' mind, the mercantilist idea is bad because it was bad when money was gold. But it's not bad when money's confetti. So they need to get over this thing about anti-mercantilist idea, and everyone should run hell for leather to export as much as possible with each other and store up these huge sacks of assets, which is actually just paper. So it's even worse. It's not even paper anymore. It's just little electrical charges on hard disks that go around at 27,000 RPM. Yeah, that's what money is. That's what wealth is. That's what assets are. Yeah, so don't worry about somebody getting too much of your confetti. Just get a lot of theirs. But somehow the economists the penny hasn't dropped on them on that one. So they're worried about, being mercantilist about things. Oh, these mercantilism is evil. Oh, shouldn't be allowed. It's oh no, it's bad. No, everyone should be getting on with it and doing lots of it and building up vast resources of other people's assets. But, one day they might crack that one.
Yeah, I guess the challenge of that is then there'll be a race for a race for the assets and the depreciation of the currencies. I guess
No, well,
that's
the assets go up in value and everybody's happy. And then you make
yeah.
more assets because there's assets to fund the assets. And there's more liquidity, so interest rates go down, so you can borrow cheaply and you can build stuff and make more assets. Now, you could say it's really bad because you get an economic explosion and then the world turns into a polluted cinder of a thing, which is what the left-wing people, they don't like money. They don't like economics. They don't like industry. They don't like any of that. Everybody should be chilling out, man, and living a life and have work-life balance. And you don't need all this stuff. You just need a woolly jumper and be happy and a carrot or two. Yeah. But that's why the socialists are not big fans of that kind of thing. Money is the root of all evil, didn't you hear?
But yeah, Clem, thanks so much for your time today. Really appreciate it. We've sort of gone over all these different topics from Trump to mercantilism to, central banks buying sort of equities, other topics, etc. But yeah, my last question is, what is one message you want people to take away from our conversation?
Well, I think it depends on your psychology. Okay. I do think you need to keep an eye on things really tightly at the moment. And I do think everybody should do a lot of housekeeping when it comes to their finances. And you shouldn't have loose money out there. You should be making sure that everything is where it should be. You should be doing your housekeeping. Don't own anything you don't know why you own it in terms of assets. And look out for very, very, very big opportunities. And either be very risk off or be able to be risk on when you see opportunities arise that you have high conviction of. Because when volatility is high, so is the potential return, but so is the potential loss. So with that in mind, if you apply yourself a bit more, you can make a lot more money. And if you don't apply yourself enough, you can really be hurt. So this is a moment between the quick and the dead. And so it's not a bad time. If you're watching this, you're probably in great shape, right? Because if you're watching this, you are engaged. And it's moments like this that being engaged, really pays. So I think it's a splendid opportunity for those that want to take it. But I think if one is passive, one can get into can end up worse off. As we've seen over the last few years, actually, it's not been a time to be passive. It's been a time to be active. And I think that this is another one of those moments where applying oneself as detached from it as possible, as clinically as possible, as cold-blooded as possible, is a really great time and great opportunity to establish further wealth. But I do think it's not a great time to be looking out the window going, la, 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 it's all going to be fine.
Yeah, great message. So thanks again, Clem. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Well, they can read my stuff on Forbes, which I've been writing for now for like 2 decades. I wrote some investment books that are still available. They're a little bit out of date, but they won't do you any harm. You can check out a new FN, which is going to be going live sometime early summer. And if you want to be on the wait list and the special VIP guest list, you can just drop an email there and we'll keep you up to date with things. And I wish everybody good fortune in the coming times. And I think there are really, really good returns to be had for those people that really apply themselves.
Yeah, great. I'll pull that in description below, but thanks again for your time.
Now, before I go, Anthony, I'm going to say, Anthony's got a great channel. Please subscribe, like, and click the bell, because that is a way of paying him back for all his time and effort, because that's what he needs to get views and to get attention, to get the algo on YouTube to actually say, this is good stuff. This is good stuff. We're going to give him more oxygen. And if you don't do that, they won't give him as much oxygen. So if you want to give him, or anybody else for that matter, oxygen of the algo of YouTube, which is live or die for channels like Anthony's, click that subscribe, click that like, ring that bell. You should. So do it.
Thank you. I'll send you the $5 over later. No, I really appreciate it. But
that's my pleasure.
Thanks again.
Cheers, Ashley.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.